everything, including gold. I mean, virtually nothing offset this inflation we've just had. So that kind of took us all by surprise. The S&P kind of goes nowhere. It's right at the bottom now since 2008. So as they started using the Fed balance sheet, debasing the currency, the stock market has just accounted for that. The Fed balance sheet's been doing that. The stock market's done that. But actually, they've netted each other out. You haven't got any richer. Gold fails. You've actually got poorer versus the Fed balance sheet.
Something is happening with assets all across markets that most people are not paying attention to. It's a result of debasement of the currency, giving a false sense of asset appreciation. In today's video, Raoul Pal will explain why this is one of the biggest issues that could come back to bite anyone into stocks, properties, crypto, or precious metals such as gold. Before you delve into this powerful investment secret, click the subscribe button and join our winning community. Two things are eroding the value of money or investments you have: inflation and currency debasement. Regardless of the circle you find yourself, your hedge fund in savings or investments may not be good enough. You could be busy focusing on the micro yields your stocks or assets are gaining, or the price appreciation, but this win may not be as good as you think. Why is this? You'll understand this shortly. In an inflation, prices of goods and services are on the rise. This could be triggered by many factors, but the baseline is you need to spend more to make the same purchases. On the other hand, we have currency debasement, which is not caused by the forces of economy, but by fiscal policies intentionally undertaken by the government. A government may decide to increase money supply or even directly choose a higher exchange rate for its currency against other currencies. This increases the value of assets in that currency. For example, if you have a house worth $100,000, it would cost more to buy that same house if the currency is debased. You would falsely believe that your property has appreciated in value, but it has not. This is because when you try to buy the same property with another currency that is not debased, then you would realize that your property is worth less than the $100,000 it cost before. This false asset value appreciation is a factor many investors never put into consideration. As Raoul Pal pointed out, countries like Argentina are experiencing this, where the prices of assets seem to be appreciating along with their high inflation. But the truth is, these assets have lost a lot of value when you price them in dollars. Since the money supply is one of the catalysts for money debasement, should you be worried about the U.S. money supply? Money supply, otherwise known as M2, has within the past 20 years grown astronomically from $4.6 trillion in 2000 to $19.5 trillion in 2021. A bulk of this M2 growth came in 2020 during the COVID-19 pandemic. About 20% of all U.S. dollars in circulation, amounting to $3.4 trillion, were created in 2020 alone.
Quantitative easing is a way of saying we're going to debase the money. But you'll see it on Twitter, people say, well, it's not debasement and they talk about some mechanism. The net effect is the same because they had too much debt. What the hell do we do with too much debt? You either have a massive inflation or you debase your currency. The Roman emperors used to clip the corners off the coins. And in fact, anybody who's ever used gold as a system of money has always debased their money by clipping the edges off. At first, you don't notice because they take 3% off. And then before you know it, they're just cutting them in half and saying, well, there you go. It's the same. And then the empire collapses. It's just, that story is several thousand years old. Inflation is a generalized rise in prices. The price of eggs goes up. The price of gas in your car goes up. The cost of employing people goes up, etc. Debasement of currency is this really weird little trick. Things of fixed supply or relatively fixed supply go up immensely, optically, because the price of the currency's fallen. Things of variable supply, like wages, corporate earnings, don't, and they don't go as much. So what you find is, after quantitative easing, what happens? Stock market goes up, gold goes up, cryptocurrencies go up, housing goes up, fine art goes up, all of that stuff. Assets. So assets are a way of storing wealth. That's what an asset really is. So in relative terms, they've held their price and the currency's fallen, makes them look like they've gone up in price. It's not. And this is what everybody gets confused with. This is why price earnings ratios have gone up so much, because the earnings doesn't move as much as the price of the asset because it's a small fraction of it. So P's keep going up the more we debase currency. If you want to see another example, you look at a chart of the Venezuelan stock market in Venezuelan bolivars, and it goes straight up. If you put it in US dollars, it's actually down 99%. So it doesn't create a generalized rise in prices. This is what everybody confused, because they thought it was an increase in the money supply in a way that you and I could get it, we can go buy more stuff. It doesn't work that way.
Another issue is national debt. Top economist Dave Andolfato says national debt can be utilized by the government as a form of money. So what would be the value of this money, and how does it affect every other thing priced in it? He says that the Fed could monetize national debt by trading lower-yielding treasury reserves for higher-yielding securities. According to Andolfato, a one-time rise in the supply of debt that doesn't coincide with a rise in the demand may indicate a shift in the interest rate, price level, or both. A higher rate of inflation is likely to be observed if ongoing debt issuance is not matched by an increase in debt demand. The Fed's monetary policy has the biggest impact on how the interest rate on U.S. Treasury securities is altered. So, yes, national debt would devalue the dollar, and our national debt is at an all-time high, well over $31 trillion.
I want my money to offset debasement, not inflation, because crypto's done a terrible job of that, as has everything, including gold. I mean, virtually nothing offset this inflation we've just had. So that kind of took us all by surprise. But the debasement, well, I just divide all of these assets by the Fed balance sheet. That's really interesting. The S&P kind of goes nowhere. It's right at the bottom now since 2008. So as they started using the Fed balance sheet, debasing the currency, the stock market has just accounted for that. The Fed balance sheet's been doing that. The stock market's done that, but actually they've netted each other out. You haven't got any richer. Gold fails. You've actually got poorer versus the Fed balance sheet. It depends what future you is, depending who's watching this and what they need. Because some people want to protect, some people want to grow, some people want to, there's different motivations. But generally, it's protect what you've got so you can maintain your level of who you are, because nobody wants to ratchet down.
Take a look at gold as a hedge. If you keep gold as an inflation hedge, you would have lost more money than the yield gold had given this year, or even the past decade. Raoul's advice is that you understand what your end game is, so you can better choose what asset to put money into and how long you can put your money down. But it is important that you consider the impact Fed policies are having on any asset you plan to invest into. Like this video and subscribe to this channel. It encourages us to do more. See you at the next upload.